Welcome back to Lamb's Cryptoverse. Today I want to talk to you about a recent video I did where I basically gave a diatribe on why I hate all these people, including professionals and financial advisors and CFPs and sell-side and buy-side analysts that all say that market timing does not work. And I didn't give any charts supporting or not supporting this, so that's what I'm going to do today. I'm going to spend most of my time showing you some information from my screen here. So let's go to it. The first one is from this guy here. His name, he owns a company called Dividend Sensei. And basically, he talks about why market timing doesn't work. And he talks about it down here, actually. I had highlighted for you. He says, timing in the market will put your retirement dreams in the ditch. And then he talks about how 98% market timers lose money, but he's not really looking at professional empirical evidence, professional timers or empirical evidence. He's just looking at data from BofA. And he goes on to say, the easiest way to virtually guarantee you underperform the market is by trying to time the market. And then he shows this BofA data, but I'm going to go to a website from BofA that actually shows that data, and here it is. And this is what they say. They go back to 1930, and he said if you sat out, meaning you didn't invest in the best 10 days of the decade, your returns would be significantly lower. And then I'm going to go show you what I'm talking about. And the bottom row here is that since 1930, the prices have gone up 18,000%. But if you excluded the worst 10 days, you would have made 3,700%. But if you exclude the best 10 days, you would have made only 28%. So in other words, they're saying you got to stay in the market. Even if you try to exclude the worst 10 days or the worst days in the market, because you're market timer, you're still not going to be able to have good performance. So they're saying stay in the market. So they're saying don't market time the market, have time in the market. That's their point. And then Charlie Bilello, he gives some information on average bear markets, and he's saying basically if there's a bear market, it tends to be a certain decline during the bear market. So he's making a case for market timing and active investing because he's saying that the average bear market happens to decline a certain percentage. So why stay in the market? And then he goes on further to say that if there's a recession, and you can see that in this third column here, it says NBER recession. And basically, this is the group that calls recession. And he points out that when they call recession, you have much steeper declines. So you can see here, the NBER called a recession a quick recession in February 2020, and the market declined 35%. And in 2000, during the Great Financial Crisis between 2007 to June 2009, the NBER called a recession, and at that time, the market declined 58%. So Charlie Bilello is saying if not only there's a bear market, but if there's a recession during that bear market, that means the stock markets are going to decline more. So he's making the case for active investing, for market timing, saying that if you know there's a recession and you know there's a bear market, there's an average bear market, that the markets decline more. So he's saying don't stay in the market 100% of the time. If you know there's a recession coming or you think there is, lower your equity investment. And then there's more data. Dollar cost averaging. I think dollar cost averaging, everyone recommends it, including people that don't recommend market timing. But what they don't tell you is dollar cost averaging is a form of market timing. But then Vanguard says that dollar cost averaging doesn't work. So the data goes back and forth. And here they're showing figure 1, it's saying relative historical probability of outperforming using a 12-month dollar cost averaging versus 60-40. So they're saying if you put a lump sum, you would do better than if you dollar cost average. Because you're, see, based on, I'm trying to read what it's saying, based on rolling 10-year period, you have a 67% probability of outperforming versus a 33% probability of outperforming if you did DCA, and that's the United States. And then they found the same evidence in the United Kingdom and Australia. Why they focused on Australia, I don't know. But they're saying that DCA, dollar cost averaging, does not work. But I think you need to be careful here because we had a very strong treasury market during this time. So I don't think they should have compared DCA with a 60-40 portfolio. They should have compared DCA equity portfolio with the comparable S&P, 100% S&P. I think you would have seen different results. So this is why I'm saying the data is all over the place. Now this data is from Shiller, basically. This is showing your equity 10-year returns sorting by CAPE valuation. And this is basically the cyclical adjusted P ratio. It's basically the P ratio adjusted by Robert Shiller. You can go to his website to look at that. And what he shows in this chart is that if you invested during the richest times, meaning if you invested when you had during a period of the highest P ratios, you would get the lowest excess returns. And that's here, my point is on it. And if you invested when you had the cheapest returns, and he's saying below 10.7, when he says 10.7, he's talking about the P ratio being below 10.7. And when it is, you get the highest annual return. In this chart, he's talking about excess return. So he's making a case for market timing, implicitly at least. Now this chart here talks about another contradiction. Maybe I should make it a little smaller for you. Buffett doesn't believe in market timing, yet notice that Warren Buffett always says he doesn't buy stocks when they're expensive. He talks about going to a store and you're shopping. He goes, he likes to buy products and stocks when they're on sale. Well, guess what? That's market timing. And he also has an indicator called the Buffett indicator, which talks about the corporate equities, basically the market cap of all equities compared to GDP. So this is, to me, a market timing indicator. And you see when it was at a 211%, it was basically saying that the corporate equities market cap were twice as high as the GDP. So he doesn't say that, he doesn't recommend market timing, yet he does market time. I think he's a closet market timer. And so what I want to say to you is market timing does work, but it should be used only when there's a market regime. So what's a regime? I couldn't find a good definition. This is the best one I could find. It says that a market regime is a cluster of persistent market conditions. They affect the relevant investment factors and the success of trading strategies. So basically what's that saying is a market regime is a persistent condition in an equity market or treasury, but in this case we're talking about equities. So that means, for example, a period of high inflation, period of low inflation, a period of low interest rates, a period of war, a COVID-19, that was a market regime. So I believe that you can use market timing under those conditions. For example, this goes way back. If you look at 1990, just before the Gulf War, there were a lot of bears, and that's why the bull to bear ratio was very low. And then the stock market took off after that time. And I have data somewhat based on sentiment, and I'm going to show you right now. This is my own data that proves, not 100%, it works over 50% of the time. And it shows you that, let me go to my, actually not to me, but to my data point here. Let me minimize that myself here. And it works when there's a market regime. So I'm going to show you some examples of that. So for maybe this wasn't a regime, but when this green line hits a high point. So here in this case, where my pointer is, it was above 6. Anytime it's above 6, it's bullish. And during the Asian crisis, it was bullish, and it's showing you the purple line, that's stocks. It showed you when the green line went over 6, that the stock market, meaning blue line, went up. Now let me show you an actual regime. And that was during 2001. We had 9/11. Remember 9/11? We had a recession. So that's a regime. We had two things that happened. One, as I said, 9/11, but we also had a recession. And you can see my indicator went way up there. And when let me make this larger, but when it went way up, so did the stock market. At this point here, stocks started rising. And I want to show you some other examples. Here, during the 2007 Great Financial Crisis, my index of sentiment became very bullish. And this is during the Bear Stearns crisis, when Bear Stearns went bust and JP Morgan took them over. You could see the market rallied after that, at least for a short period. And then actually, what I should have said is the first Bear Stearns crisis was here, basically in August 2007, and then Bear Stearns was bought out in early 2008. And both times my readings gave a bullish reading. And then it gave a bullish reading. It was a temporary reading when the Lehman event occurred in September 2008. That's why the green line here went through the roof. And the market followed. It rallied short term. And then at the ultimate market bottom, which was here, my indicator gave yet another bullish reading, and that was the bottom here in March of 2009, and that was the beginning of a big bull market in stocks. So you can see the sentiment index does give readings, but there has to be a regime change. And the last one or two regime changes were here, and it's going to be hard to read. But I have this red line here denoting the regime change of when interest rates start rising. And you can see here, my indicator hit a low of 3 in June of 21. And that was maybe a little early, but in June of 21, it was shown that there was complacency. And what happened in the beginning of 22, that's when rates started going up. And I actually put a table here to show you that rates started going up in March of 2022 by 25 basis points, and then 50, and then 75, 75, and 75 again, and then we're probably going to get 75 again this week. So we're seeing that this period here with the vertical line, red line, is a regime change of higher interest rates. So during regime changes, I'm saying you can time the market. So my indicator was already bearish between June and November 21. But even without that, you can see that interest rates were going up, meaning there's a regime change, and that's when you need to sell stocks.